If you are over 60 and you have money in a bank account, there is a rule that took effect earlier this year that most seniors have never heard of. A rule that gives banks the legal authority to hold your money for up to 85 days if their internal systems decide that a transaction involving your account looks suspicious. Not 5 days, not 15 days, up to 85 days. That is nearly 3 months, during which your own money can sit inaccessible in your own account, while a bank conducts an internal review that you had no advance notice of, and that you may have very limited ability to speed up or appeal. And here is the part that is genuinely important to understand. This rule was not created with bad intentions. It was created specifically to protect seniors from financial exploitation, and the problem it is trying to solve is real. Older Americans lose tens of billions of dollars every year to financial fraud, and banks have been under increasing pressure to do more to stop those losses before they happen, rather than apologizing for them after. The 85-day hold authority is one of the tools regulators and legislators have given banks to intervene when they see something that looks like potential exploitation. The challenge is that the system identifying whether a transaction looks suspicious is not a human being sitting at a desk who knows you, your situation, and your financial history. It is an algorithm, and algorithms make mistakes. Algorithms flag legitimate transactions as suspicious and legitimate account holders as potential fraud victims. And the result is that seniors who are doing nothing wrong wake up to find their account frozen at exactly the moment they need access to their money. This video covers what the rule actually says, how it works in practice, which types of transactions are most likely to trigger a hold, what your rights are if your account is frozen, and the specific steps you can take right now to reduce the likelihood of your account being frozen unnecessarily, while still benefiting from the legitimate fraud protection these rules provide. Before getting into the specifics, share this with every person you know over 60 who has a bank account. This is the kind of rule change that matters most to people who never heard about it until their debit card is declined and they are standing at a pharmacy trying to fill a prescription. One conversation now can prevent that moment from happening. Let us start with the legal framework, because understanding where this rule comes from is important for understanding both why banks are doing this and what your rights are. The authority for banks to hold funds and accounts belonging to senior customers when they suspect financial exploitation comes from a patchwork of state laws and federal guidance that has been expanding steadily since 2016 and that reached significant new coverage in 2024 and 2025. At the federal level, the Securities and Exchange Commission adopted rules in 2018 that allowed registered broker-dealers to place temporary holds on disbursements from accounts when they reasonably believed financial exploitation of a senior or vulnerable adult was occurring. That framework covered investment accounts, but not standard bank accounts. Beginning in 2021, an increasing number of states began passing their own elder financial exploitation protection statutes that extended similar hold authority to banks, credit unions, and other depository institutions. As of 2025, a majority of states have enacted some version of this legislation. The hold periods authorized under these state laws vary, but they commonly allow an initial hold of between 3 and 15 business days, with the ability to extend if the institution is actively investigating. In some states, when the matter is referred to Adult Protective Services or law enforcement, additional extensions are permitted, which is where the 85-day figure enters the picture. To be precise about that 85-day number, it is not typically a single 85-day hold issued all at once. It is the maximum cumulative hold period that is possible when an initial hold is extended to the maximum allowed under state law, and then a referral to a state agency triggers an additional hold period under the state agency referral provisions. The actual experience for most account holders is shorter than this maximum, but the maximum possible period of 85 days under the most expansive interpretations of the combined state law provisions is real, it is documented, and it represents the outer boundary of what an account holder might face in the most complicated situations. The more common experience, in states where these laws are active, is an initial hold of 3 to 10 business days, with a possible extension to 15 to 30 business days if the investigation requires additional time. Still significant, still potentially disruptive, and still something that most account holders had no idea could happen until it happened to them. Here is how this plays out in practice with a specific example, because the abstract description does not capture the real-life impact as clearly as a concrete situation does. A 72-year-old woman has been a customer at the same bank for 28 years. Her Social Security check deposits into her checking account on the third Wednesday of every month. She pays her utility bill, her insurance, and her rent through automatic transfers that draw from the same account. She has a pattern of activity that has been essentially the same for years. One month, her granddaughter gets engaged, and the family decides to contribute to the cost of the wedding venue deposit. The grandmother wants to give her granddaughter $10,000 as a gift toward this deposit. She goes into the branch, sits down with a teller she has known for years, and initiates a wire transfer of $10,000 to an account number her granddaughter provides. The bank's fraud detection system flags this transaction. It is significantly larger than any single transaction she has made in the past 3 years. It is going to an account the bank has never seen associated with her before. It fits a pattern that the algorithm has been trained to associate with a category of fraud called grandparent scams. The teller, following the bank's current fraud protection protocol, cannot simply override the system. The wire is placed on hold. The account is flagged for review. The grandmother is told that there may be a brief delay. She is not told how long the hold will last. She is not told what the specific concern is. She is not told what she needs to provide to resolve the hold. She goes home. Her granddaughter is expecting the wire. 3 days later, the grandmother calls the bank. The review is still in progress. She is told she will hear within 7 to 10 business days. Her routine automatic payments process normally because the hold is on outgoing transactions, not on incoming deposits. But she cannot send any additional funds while the review is active. The venue deposit is at risk of being lost. The family is in an uncomfortable situation that the grandmother never anticipated. Eventually, the bank's review team contacts her. They ask her to confirm, through a call with a bank representative, that she is making this gift voluntarily, that she is not being pressured, and that she is aware of the amount being sent. She confirms all of this. The wire is released. The total delay was 11 business days, which in calendar terms was about 16 days. The venue held the date. The deposit was not lost. But the experience was stressful, confusing, and frustrating, and the grandmother had no idea when she initiated the transfer that any of this could happen. That experience is the mid-level version of what can occur. The more serious versions involve holds that last longer, situations where the bank contacts Adult Protective Services because the system flags additional concern, and cases where the account holder cannot easily confirm their voluntary intent because of health or communication challenges. Now let us talk about which transactions are most likely to trigger a hold, because understanding this helps both in avoiding unnecessary friction and in preparing when a significant transaction is genuinely planned. The types of transactions that fraud detection algorithms at major banks are trained to flag in accounts belonging to customers over a defined age threshold, typically 65 or 70, include the following categories. Large single transfers or withdrawals that are significantly out of pattern with the account's history. If an account has processed primarily small transactions for years, and then a 5-figure or 6-figure transaction appears, the system treats this as a meaningful departure from established behavior. Transfers to new payees or accounts. When money moves to an account, a person, a business, or an institution that the system has no prior record of being associated with this customer, the novelty is flagged as a risk indicator. Multiple rapid transactions in a short period. If several transactions occur in quick succession, particularly if they are moving money to different destinations, this pattern can resemble the behavior associated with fraudulent schemes, where victims are directed to send multiple, smaller amounts. Wire transfers to international destinations. Wire transfers to accounts outside the United States face heightened scrutiny, regardless of the account holder's age. But this scrutiny is compounded for accounts in the senior customer category. Transfers to cryptocurrency exchanges or to entities associated with cryptocurrency. The use of cryptocurrency has become a common vehicle for fraud proceeds, and transactions moving money toward crypto-related entities are among the most consistently flagged across all banks. Transactions that occur shortly after a period of account inactivity. If an account has had minimal activity for several months and then suddenly processes a large transaction, the contrast triggers the system. Transactions that occur in conjunction with unusual customer interaction patterns. If a customer who normally conducts business independently has recently been accompanied by a third party who appears to be directing the interaction, some banks now document this as a risk indicator in the account notes. Understanding this list does not mean that any of these transactions is inherently problematic. Large gifts happen for legitimate reasons. Wire transfers to family members happen. New payees get added regularly for perfectly normal reasons. The issue is that the algorithm does not know the reason. It knows only the pattern. The most effective way to reduce the likelihood of an unnecessary hold on a large or unusual transaction is to notify the bank before the transaction occurs, rather than initiating it without preparation. This is called a transaction pre-notification, and it is the single most effective tool available for managing the interaction between legitimate financial activity and a fraud detection system that does not know you personally. Before initiating any transaction that fits any of the categories described above, particularly anything over $5,000, anything to a new payee, or anything that represents a departure from your normal account activity, call your bank or visit the branch. Speak to someone who can document the conversation. Tell them the following information. You are planning to make a specific transfer on a specific date for a specific amount to a specific payee for a specific reason. Provide enough detail that the documentation in your account notes reflects the voluntary and intentional nature of the transaction before it occurs. When the transaction is then initiated, the fraud detection system that flags it for review encounters a note in the account file that documents an advanced conversation describing exactly that transaction. In most cases, this note is enough for the review team to confirm quickly that the transaction was intended and voluntary, and the hold is lifted in hours rather than days. This one habit, calling before initiating any large or unusual transaction, is the most practical protection against unnecessary holds and the most effective way to ensure that legitimate transactions move smoothly. Now let us talk about your rights if a hold is placed on your account, because knowing what you can do changes the experience significantly. When a bank places a hold on your account under these Elder Financial Exploitation Protection provisions, you have the right to be notified that a hold is in place, though the notification requirements and timing vary by state and by institution. You have the right to ask why the hold was placed and what the anticipated timeline for resolution is. You have the right to speak with a supervisor or a specialized review team member rather than a general customer service representative, and escalating to that level consistently produces faster resolution. You have the right to provide documentation or explanation that addresses the specific concern the bank's system flagged. If you can demonstrate to the review team that the transaction is voluntary, intentional, and that you understand what you are doing, the review can typically be resolved more quickly than if you simply wait for the bank to complete its investigation independently. If you believe the hold is unreasonably extended, and you have already provided sufficient explanation and documentation, you have the right to file a complaint with your bank's compliance department and with the Consumer Financial Protection Bureau. The CFPB accepts complaints about banks and financial institutions at consumerfinance.gov and will take up the matter with the bank on your behalf. While this process takes time and does not immediately release a hold, documented complaints create a record and often accelerate resolution in cases where the bank is being slower than the situation warrants. If the hold involves a referral to Adult Protective Services or another state agency, you have the right to know that the referral occurred and to understand the process that follows. APS involvement in a financial hold case typically means a social worker or investigator will contact you to assess the situation. Being cooperative and clear in that communication is the fastest path to resolution. One thing to understand clearly